Hello, this is a gold update. Today's date is December 14th, 2011. And the price actions for gold today is very important. Gold has just broke an uptrend that has been in place since 2009. And from there, we need to find the next support. This could be a false signal, but a false signal is the more than unlikely case scenario. So I would look for it, but don't bet your money on it. Now, the uptrend in gold has been in play since 2001. Around April 2001 is when it commenced, and it's still in the uptrend today, all the way till today. But it is also on a downtrend, but in the more shorter term. In totality, this downtrend that has just started recently this year should be a correction that's going to find support somewhere around a 33-50% or 66% retracement line, or fall on one of its more primary or secondary support trend line. Normally, my baseline suspicion when looking at charts, I would find the long-term support and then the 50% correction and see where they meet, and assume prices should try to pull towards that direction, even though they don't have to go there. But that's like where gravity wants to pull them, if this is a correction of the trend that started from 2000. So for short-term investors in gold, you might expect them to flee. If you are a short-term investor, I would encourage you to look at your position on the long side very seriously, because the prices should be declining from here forward until it finds its support in this correction. But for long-term investors, I wouldn't really worry about it. And plus, downswings after trend breaks normally collapses pretty rapidly. Uptrends take much longer to accomplish than downtrends. It's harder to climb up a ladder to the second floor of a building to jump off the roof of it. So it might not be long from now that we find support, and for people that's on the long side, it might be quite a scary ride. To look for support, I draw a trend line from mid 2005 all the way till today, and then you will find that we have a support area somewhere between 12 and 1100. This uptrend in gold that has been in play from 2002 all the way to today has had accelerate trend lines. The recent price action has broke its third accelerate trend line, and now you want to look for support at its second accelerate trend line. But if it's a true correction from the trend in 2001, you can expect a retracement all the way back to its primary trend. But for long-term investors, you can more than likely look at this as a correction instead of a start of a new long-term downtrend in gold, which is possible, but I highly doubt it. Here's a picture of the national debt clock. It's from today. As you can see here, we have passed the 100% debt to GDP ratio. And when you run it live, you can see that these numbers are climbing pretty rapidly. Increasing debt is another way of increasing the money supply. The Federal Reserve Chairman Ben Bernanke promised us in the summertime to keep interest rates near zero for the next 2 years. The only way to do that is by physically going into the market and manipulating it. And when he decides to do that with whatever instrument or whatever he decides to call it, it's going to expand the money supply. And any expansion of the money supply puts upward pressure on the price of gold, due to the fact that historically people has always used gold as a store of wealth, which a store of wealth is actually what money is. It's something valuable that can be traded for other goods that other people recognize as value. But you can't forget the importance of being a store of value. That's the whole point of money. That's the whole point of it historically, is to be able to store your value. Now, since we have all kind of competing currencies competing with monies in a convoluted financial system, we've approached a very serious global financial situation, which during this time period, I would rather have my savings in a safe or safety deposit box or buried somewhere, wherever you want to put it, in physical gold or silver. Over time, it will beat inflation. Government worldwide are doing similar policies that we are doing here in the United States. Even though Europe is trying austerity measures, which is a fancy word for cutting back services on the public to try to handle their debt situation because they don't have a printing press like we do. But there's a downside to our printing press. Downside is it devalues the money. So when he say he's going to keep interest rates low, what that does is turn on the printing press. In the long run, it devalues anything valuated in dollars. Commodities run in the opposite direction of a falling dollar. Commodities are resources. Money, historically, as a medium of exchange, is used to trade. Today we have currency, and it works off supply and demand just like anything else. And the currency, it has its supply and demand factors. The demand for your currency is closely tied to the demand of goods and services. So if the demand for goods and services are going down and your supply of money is increasing, then you can expect the value of your goods and services to go up. Now, since gold is no longer a currency per se, then it has been pushed into the sector of a commodity. So gold, as well as other commodities, are an inflation hedge, which inflation is the expansion of the money supply. They've been dramatically expanding the money supply over the last few years, but the prices of our commodities and services are not yet reflecting this. They have been able to export their inflation to the third world and to the BRIC nations, the exporter of commodity